Every March, the Schwab U.S. Dividend Equity ETF SCHD does something that drives investors crazy. It removes companies that many investors consider some of the strongest businesses out there. Names we've built income plans around. Names we've defended in the comments for years. And every single year, the same panic sets in. Why would they drop a winner like Broadcom? Is the fund broken? But here's the question almost nobody stops to ask. What if it's doing exactly what it's designed to do? And most investors just don't know the rules of the game. So today, we're going deep into the mechanics of the March 2026 Reconstitution. I'm going to show you why great companies get the boot and the sectors I'm watching for some significant unexpected moves in just a few weeks, including a few stocks that might be on the chopping block. Let's get into it. We need to be clear on what SCHD is actually trying to do. SCHD tracks the Dow Jones U.S. Dividend 100 Index. It's rule-based, no fund manager making judgment calls. A set of criteria runs automatically once a year, and the results are what they are. To qualify, a company must have at least 10 consecutive years of paying dividends. That's the entry ticket, no exceptions. Then 4 factors are scored and ranked against each other. Cash flow to total debt. Can this company sustain its dividend? Return on equity. Is it generating strong returns for shareholders? Dividend yield. How much income relative to price? And 5-year dividend growth rate. Has it been growing that dividend consistently? Those 4 factors are equally weighted into a single composite score. The top 100 scores make the index. Everyone else is out. Here's the line I want you to remember. SCHD is not trying to own the fastest growing companies. It is trying to own the most financially durable dividend growers. That's it. That reframes everything. Once you understand that, everything about the Reconstitution starts to make sense. In March 2024, SCHD removed 23 stocks, one of the biggest reconstitutions ever. The loudest reaction was to one name, Broadcom. Broadcom is a genuinely exceptional business. Its AI chip business was surging. Its dividend growth record was strong. No serious analyst was calling it a bad company, and yet out it went. So what actually happened? Broadcom's stock had surged massively, driven by AI enthusiasm. When a stock price runs up that fast, the yield does something most investors don't think about. It drops. Broadcom's dividend yield had fallen to roughly 1.7% by the time of Reconstitution. For a fund scoring companies on yield relative to peers, that's a problem. SCHD has 100 seats. Broadcom lost its seat to a better scoring competitor. SCHD didn't remove Broadcom because it was a bad company. It removed Broadcom because it no longer ranked highly enough on the dividend quality metrics the index requires. The rules cut in both directions. The same mechanism that removed Broadcom also quietly weeds out companies stretching to maintain a dividend they can no longer afford before that company becomes a real problem in your portfolio. I understand why removals frustrate people. When you've watched a name compound for years, it genuinely feels wrong to see it go. But the rules don't care about feelings, and that's exactly the point. Sector dynamics can shift dramatically. SCHD's 2025 Reconstitution pushed energy exposure from roughly 12% to nearly 20%, making it the fund's largest sector. That happened because energy companies were generating strong cash flow and paying competitive dividends. The index didn't make a call on oil prices, it just followed the scores, which brings us to 2026 because those scores have shifted again. What I'm watching for March 2026, these are not certainties. Think of these as things worth watching. Energy is likely heading back down, but the story is more interesting than it sounds. SCHD entered 2026 with energy at roughly 20%, the result of the 2025 Reconstitution. Through much of 2024 and 2025, that overweight dragged on performance as oil prices stayed under pressure. Then something shifted in early 2026. Energy surged, partly driven by the realization that AI infrastructure requires enormous amounts of power. That bounce is part of why SCHD has had such a strong start to 2026. Analyst models, including simulations published on Seeking Alpha this month, project energy could fall back to around 12%. Names like Halliburton, Valero, and Ovintiv are among those potentially exiting, not because the businesses are struggling, but because their stock prices have risen enough to compress their yields below where they need to be to compete on the composite score. Financials are likely to gain ground. Financials score well on return on equity and dividend growth. 2 of the 4 criteria. Multiple models project the financial sector weight could increase by 4 to 5 percentage points in March. Healthcare also looks stable or stronger. It continues to score well on cash flow and dividend history. Watch for that exposure to hold or even grow. One thing I'm watching that doesn't get talked about enough, the most vulnerable names aren't always the obvious ones. They're often stocks that have had a strong run, Once investors feel good about where price appreciation has quietly compressed the dividend yield enough to fall down the rankings, the removal feels like a surprise. The score says otherwise. And if I had to make one call, I wouldn't be surprised if at least one energy name that investors consider a core SCHD holding gets removed this March. Not because the business collapsed, but because a strong 2026 price run quietly did to their yield exactly what AI enthusiasm did to Broadcom's in 2024. The math doesn't care how good the story sounds. As of this recording, SCHD is up roughly 15% in 2026, the same characteristics that made it an underperformer during the AI tech boom. Low tech exposure, value tilt, dividend focus are now exactly what the market is rewarding as the Magnificent Seven has pulled back. The Reconstitution lands at a genuinely interesting moment. If a company gets removed from SCHD, resist the urge to panic. Ask yourself two things. First, did the index see something real? Yield compression on a surging stock isn't just a scoring quirk. It's information. It means the stock no longer fits what SCHD is designed to hold. Second, are you in SCHD for the right reasons? If you're in it for durable income and dividend quality, Reconstitution is the mechanism that maintains exactly those things. It's not a disruption to the strategy. It is the strategy. The fund will remove great companies again in March 2026 and the year after that. That's not a flaw. That's the design. And honestly, it's one of the reasons I hold SCHD as one piece of a well-diversified portfolio, not the whole thing. The Reconstitution keeps the strategy disciplined, but diversification is what keeps you protected. I'd love to hear from you. Drop a comment below. Which sector do you think benefits most from the March 2026 Reconstitution? And if you want to see the biggest 8 myths investors have about SCHD that are completely wrong, check out this video right here. I appreciate you watching. Take care, and I will see you next time.